In this screencast, we are going to continue our work with problem P1-4B out of Financial Accounting, the 8th edition by Wygant, Kizo, and Kimmel. When we left off in the first screencast, we had just gone through all these transactions and we had recorded them as assets, liabilities, and shareholders' equity. And in the end, we had these various balances in our accounts, and our total assets, which are our cash plus our accounts receivable plus our supplies plus our equipment, equaled $28,800. Our liabilities were $11,500. That's our notes payable and accounts payable in this instance. And our shareholders' equity equaled $17,300, which is our common stock plus our retained earnings plus our revenue, less the expenses that we paid and less the dividends that we paid. Our total liabilities and shareholders' equity equal $28,800, which does equal our total assets. Our accounting equation is in balance. Now, what we were doing here was the first two parts of accounting, which is identifying all our economic events, which was up here, and then recording them, and we recorded them in this format. Now, the third part of accounting is to communicate that data to interested users, either external or internal users. And we generally do that by way of financial statements. So over here, I have put in 3 of our 4 main financial statements. At the top, I have our income statement, and then I have our retained earnings statement, and finally, I have our balance sheet. Now, our income statement presents the revenues and expenses and resulting net income or net loss for a specific period of time. Our retained earnings statement summarizes all the changes in retained earnings in shareholders' equity for a specific period of time. And finally, our balance sheet reports all of our assets, all of our liabilities, and all of our shareholders' equity on a specific date. And our balance sheet, as the name says, must balance. So now we're going to take the information that we recorded here and we're going to put it into our income statements so that any interested users can use this information in a more easily used format. And we always begin with our income statement because you'll see that the information from the income statement rolls up into that retained earnings statement, which rolls up into our balance sheet. So in our income statement, we begin with our revenues. And if we look over at what we have recorded here in our table, our total revenues at the end of May were $6,300. So we can record that as our service revenues. And I already have our formulas in there. So right now it looks like we've got net income of $6,300. Now, that's the only revenue that we have. However, we do have several different expenses. And now we will record those expenses. In our table over here, we simply recorded our expenses in total at $3,100. But in our income statement, we are going to separate those out. And we had 4 different expenses. We have the salaries and wages that we paid. That was $2,100. We paid those on May 17th. You can see that over here. We have our rent expense that we paid, and we paid $800 in rent on the 2nd of May. We have our advertising expense to advertise in the county news on the 5th of May. That was $50. And we also have our utilities expense of $150 that we paid on the 30th of May. So when you take your revenues and then you add up all of your expenses, $3,100, just as we had down here, you subtract those expenses from your revenues and you end up, in this case, with net income. If this were a negative number, it would be a net loss. And that is $3,200. And we will be using this in our next statement, our retained earnings statement. So for our retained earnings statement, we're trying to see what retained earnings is doing over the month. And so we begin with what we started with. And on May 1st, if you go way back to our balance sheet over here, retained earnings had a balance of $800. So we can place $800 here as our beginning balance in retained earnings. Then our net income is added in to our retained earnings. So all these revenues and expenses get rolled up into that retained earnings. And our retained earnings was $3,200. And I've highlighted this in orange so that you can see that, yes, this $3,200 rolls right down there. And we get a subtotal of $4,000. Now, the other thing that we take into account in our retained earnings statement is any dividends that we have paid out. And in this case, we did pay out $700 in dividends on the 12th of May. And this is a decrease from retained earnings. It's not an expense. It doesn't belong on our income statement, but it does cause a decrease in retained earnings. And we end here with a balance of $3,300 in our retained earnings on May 31st. And this is going to be important in our balance sheet. Now, in our balance sheet, where we list all of our different accounts, our assets, liabilities, and stockholders' equity accounts on a specific date, we're going to do that at the end of the month on the 31st. And so we look at our balances on the 31st. Well, we had a cash balance of $17,700. So we can put that there. And if we look down at the bottom of our accounts receivable, our balance was $2,800. Our supplies showed a balance of $1,000. And our equipment showed a balance of $7,300 at the end, so that our total assets are $28,800, which we already calculated down in our table here. Then we move on to our liabilities. Our notes payable were $5,000, and our accounts payable were $6,500. So we had total liabilities of $11,500. Our common stock, we can see, ended up at the end of the month at a balance of $14,000. And then we put in our retained earnings in the balance sheet. We don't list out all our separate revenues, all our separate expenses, all of our dividends in the balance sheet. All of those amounts have been rolled up into retained earnings, and retained earnings is what we put on the balance sheet. So we know from our retained earnings statement that the balance at May 31st was $3,300. And our balance sheet, I put these in bold, must balance just like our accounting equation always balances. And we can see we have total assets of $28,800 and total liabilities and stockholders' equity of $28,800. So our balance sheet does indeed balance. And now we have financial statements that different users, either external or internal, most likely external, can use. So who would use these things? Well, the IRS would use this. They would want to know what our net income is. They would like to know what to tax. We would also have labor unions looking at this. If net income's high, they might be thinking maybe we can renegotiate our labor contracts and get a little more money for employees. If you're a bank and you're thinking of loaning money to Paulus Consulting, you might look and say, well, they've got $28,800 in assets. What do they have in liabilities? Do they have room to take on more debt? Will they be able to pay us back? So this is how these financial statements would be used by external users. Now, in the next screencast, we are going to move on to how we actually record things in accounting. This was a nice way to look at how these transactions behave in the different accounts, but this isn't actually how we record things in financial accounting. So we will look at that in the next screencast.